I was reading an article on Bloomberg with regards to the Canadian real estate market, and the headline says that the market is in a stable state, which means the market is balanced. It's not a buyer's market, it's not a seller's market. Now, I'm talking about Canada as a whole, not in a particular geography. Okay, so which is I think accurate statement. When we look at this chart from Korea, you can see that how the SLNR, which is the sales to the new listing ratio, which means how many new listings are being absorbed by the market, is trending downwards, while at the same time we are seeing the amount of inventory is climbing up. And if the trend goes further up, then of course it will put downward pressure on the house price as well. So I agree that the market is right now in a balanced territory. But if we read through the statements in this article, you would realize that a lot of these housing experts, quote unquote, they make these statements in isolation of what's happening in the economy. Okay, for example, let's go through it. So the Canadian housing market softened slightly in July from a month earlier as sales of existing homes dipped and new listings inched up. Okay, so demand is low, inventory is coming up. Of course, the sales volume is historic low, so that is keeping the price floor for the market. The sales were down 0.7% from June when seasonally adjusted, though up for 4.8% from a year earlier, while new listings were up 0.9% on monthly basis. So listings gradually is coming up, sales is gradually coming down. There is no demand, right? And it's basically giving them this floor because the investor class is completely out of the market, guys. Okay, the people I talk to, right, in terms of giving them, strategy about the financial planning and real estate planning, nobody's willing to invest into real estate right now, especially in Canadian real estate market. Why? Because the numbers are not making sense at all. Okay, and when you have uncertainty about the economic conditions, nobody is willing to bat into the real estate market from investment perspective. Okay, there's a big difference when you buy a property for investment versus when you buy as your primary residence. When you buy a property for a primary residence purpose, you're going to live there. You have to grow your kids. You are looking for a good school neighborhood where your kids has to go to school and grow up and then basically raise your family there. So there is a big difference in terms of making decision about buying a property as your primary residence versus buying it for investment purpose. Okay, so the investor class completely out of the picture. Nobody's buying this. The kind of people are buying right now are the one who are genuine buyers. Either they're selling their existing property and buying the next one, or downsizing or upsizing, divorce issues, whatnot. Okay, so further we look into this article. The small pullback in July came despite a second rate cut from Bank of Canada late in the month. While the start of the cuts haven't yet translated into notable bump in sales, conditions are starting to shift, said CREA Chair James Mabby in a statement Thursday. Now, a lot of real estate bulls on Twitter or other social media platforms, yes, they were claiming that as soon as the rate cut starts happening, the market will drip higher. Remember that? Okay, and I was on my channel keep telling you guys, not necessary, because if the rate cuts happen, and if we know the history, the rate cuts are always have been the response to the economic downturn, okay, some sort of an economic crisis. It was never done from a position of strength, but from a position of weakness. Okay, so if the central bank is going to cut rates, that means they're responding to an economic crisis, and in that economic crisis, you would not be thinking that housing market will dip higher. Further, if you read into it, while it wasn't apparent in July housing data from across Canada, the stage is increasingly being set for the return of a more active housing market. That's what Mr. James Mabby is telling you. And if you read through the entire article, you would not find a single statement about economic condition getting deteriorated, about unemployment going 6.4% and increasing, especially the young people losing jobs, and the people aged between 15 and 24, their unemployment rate is 14%. Okay, the highest since 2008 crisis. And when we see the businesses like Jet Airlines going bankrupt, What happens to those employees when a company goes bankrupt? They become jobless. So when you see a lot of unemployment, going up with businesses going bankrupt, you don't see the economic environment for people to buy properties. Okay, so let's continue read this article. More rate cuts expected ahead, along with pent-up demand, should lead to a rekindling of the housing market next year. That's what the association is telling you. For now, the market remains fairly subdued, with sales volumes at reasonable levels and for the most part listing floor not saturating the market and prices holding steadily, said BMO economist Robert Kavchik, which is true because the demand is not there. Okay, imagine if the supply suddenly starts coming up. What's going to happen with the house price in the same level as we see the demand is low? Okay, stability describes the Canadian housing market, he said in a note. Considering the massive swings in prices, activity, and interest rates in recent years, this is an outcome that the industry should be thrilled with. Fine. Okay, the rise in listing and dip in sales pushed the market a little bit more in favor of buyers, with the sales to listing ratio coming in at 52.7% in July, down from 53.5% in June, but that's still considered balanced territory. Going back to my previous argument. Okay, and while listings were up from last year, the national average home price was down only 0.2% from the last year to $667,317. Okay, again, if the demand is not low and the sales volume is historic low, then of course the housing prices will not move down. Okay, they can gradually grind lower as we move along, but it's giving them a floor because there's not much demand. Okay, and the sellers are also not liquidating their properties. Investors may liquidate because if they are carrying costs like mortgages and taxes and maintenance, so they are basically burning cash. So if they are not collecting rents, they may liquidate those properties. But a primary user, a end user who is living in the property, they will try everything in their best to keep the property as long as they can. Okay, so there's a big difference who is the holder of the property. Home price index, which aims to represent typical home sales, did show a 3.9% decline from the last year, while up 0.2% from June. So it's grinding lower, but if the prices has gone up 0.2% from June, doesn't really make a huge difference because you have to look at the trend, the long-term trend. Markets remain favorable for sellers in prairies and Atlantic Canada as affordability attracts buyers, while Vancouver and Montreal look mostly balanced. A lot of people are moving out of province because of affordability issues, but they are actually increasing the nominal price in those areas when they bring their purchasing power along with them. Ontario is the soft spot with a scattering of buyers markets, while Toronto's detached market is holding firm even as the condo market has been inundated with supply. So there is a huge supply coming up in the condo market, especially from a pre-construction perspective. A lot of investors who have purchased those pre-construction condos, they're not able to close them now because their intention was to flip it on assignment. Now they're not buying, they're not finding another buyer to offer their property. Most likely they are going to dump those properties and sell them, at a loss. And this is where we're seeing a lot of selling activity happening in condo market. Maybe it's a good time to buy a condo. Always buy when everybody's selling, always sell when everybody's buying. That's the famous quote from Warren Buffett. Kavchik said that recent rate cuts haven't changed the market much. That was expected as few buyers are using variable rates. I don't buy this. Okay, you have to understand the economic conditions as well, Mr. Kavchik, right? If you have unemployment going up 6.4%, if you have businesses are laying off people and going bankrupt, in that situation, nobody's going to make $1 million purchase for sure. But as the bond market, which determines fixed rate mortgages, begins to respond to anticipated cuts ahead in both Canada and US, the borrowing rates could start to come down. Maybe not, because the bond market is controlled by the market itself, not the central banks. Okay, the central banks can only influence the short-term rates, but when it comes to long-term lending rates, it is basically influenced or controlled by the market itself. Okay, if you've been watching my channel, you understand the bond market, how the bond market works. The players in the bond markets, they decide what rate should be given on those treasuries, not the central banks. If we head into next spring with borrowing costs down around 4%, things could get more interesting. If people keep their jobs, yeah, for sure. Bank of Canada's next rate decision is September 4, while the US Federal Reserve next makes a rate announcement on September 18. So you know the drill, right? So the whole article, you have seen this. Not a single statement about the economic conditions, the layoffs, the unemployment, the yield curve, right? The deteriorating economic conditions, the contracting GDP, the GDP per capita falling for the last 8 quarters. Nobody is mentioning that. So you realize all of these housing experts, they're living in a silo where they only look at rates and the housing volume. That's it. They don't care about what's happening in the economy, what's happening with the unemployment rate, what's happening with the job cuts, business layoffs, and the global economic conditions that is impacting Canada as well. Okay, so if you are looking for a purchase, consider all of these news with a pinch of salt, collect all the data, and then make an educated decision about your purchase. Because if you push yourself just based upon their narrative, you may be at a wrong spot, making a wrong financial decision. Okay, anyway, let me know what you think about that. Put your comments down below. If you like this video, give me a thumbs up, subscribe, check the links in the description below. There's some free stuff available. Check it out, especially the stake platform, and I'll see you in my next video. Take care. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.